Now, angel investors, okay? Angel investors can be a source of personally detached funding, but at a much higher cost, which is losing equity in your company and voting control. Venture or gross capital, VCs or GCs. Now, VCs or GC firms like Sequoia and KPCB will be the toughest funding to acquire, as they disperse in rounds rather than in lump sums. They focus on larger business ventures, and there are more than 1,000 firms in the United States with various verticals as their focus. They all have various degrees of success, so feel free to educate yourself on this. Now, the VCs recoup their capital investment 75 to 80% of the time. Okay? They charge interest rates between 5 to 20%, and they require median valuations of around 25 million in order for them to invest. So you have to make a pitch to them, just like in Shark Tank. Now, the majority of VC firms are located in California, New York, and Texas. So as we move into the third phase, you'll need to tap into your equity and debt. Now, the same ratios of equity to debt at this stage, with high equity and low debt financing being a much easier way to finance and acquire lending than the inverse, the government and private equity will go ahead and offer, those options. So debt financing on the one side, equity financing on the other side, same as we talked about in a second. Private equity, government, same as we mentioned before. But now we're going to go ahead and add crowdfunding. So on the crowdfunding side, as I mentioned, we have a New York company, Kickstarter.com out of Brooklyn. They offer consumer gadgets. They have 54,000 projects, 900 million raised, 5.4 million pledges, and a 5% fee, with 44% of those projects were funded in 2013. Indiegogo.com out of Canada focuses on arts and products. 44,000 projects, 200 million raised, 4 to 9% fees, with 34% of those 34,000 funding. Lendingclub.com out of California. They have personal loans up to $300,000, $3 billion raised, 16% APR. Ouch. Okay. But it's a lending club. They have fees, credit fees, and tax preparation fees. So many large and small companies are using crowdfunding for product development as well as new business ventures. Now, it is really the most exciting group to enter the field and promises to help entrepreneurs like you and I to bring products to market at record speeds with little to no risk or long-term financing cycles by selling them cycle to consumers before it's actually manufactured. So there are more than 200 crowdfunding sites raising over $2 billion in the United States and close to $5 billion worldwide. So, as we close this monthly video blog, let's go ahead and talk about phase 4. And that would be maturity and decline, what I'd like to call aging gracefully. Again, it applies to brick and mortar, enterprise. So as the business matures, the natural tendency is to sit back and relax, watch the profits roll in. However, perhaps making as few adjustments as possible, right? Nice and easy. Well, guess what? If you're just trying to keep the momentum going, you're missing the mark. That's the most dangerous and difficult time in the life cycle of a business, as new competitors with lower overhead or more experience may be able to innovate much faster and easier than you. So, the funding options on this stage will require that you make a solid presentation with high valuations as the bait on the hook. And of course, that you are prepared, okay, to lose 10 to 50% of your company's equity to the venture capitalists that you seek. If this is too much a cost for you, then you must prepare for this contingency earlier on by saving for the rainy day that will eventually come. Now, the fate of your company is in your hands. And only you and your executive team can determine which is the best course of action at this crucial point. Depending on your continued enthusiasm for your industry, your company, your employees, your products, your supply chain, and your customers. It may be time to expand your scope by opening up satellite offices, expanding distribution channels, setting up a franchise program for mergers and acquisitions, going public in the stock market, right? Whichever which way you want to grow. But if you're successful in your business, you're going to have to mature. You're going to have to grow, innovate, and you're going to have to prepare for competition. You can choose to sit back and relax, or you can choose innovation as part of your business process. I propose that the latter is, better than the former. Now, any one of these actions will require additional resources, financing, process, human capital that you may not possess. So if you decide to have an IPO and you want to underwrite that, that's an expensive endeavor that many companies dread. But access to an unlimited supply chain of working capital with no strings attached can be a very tempting proposition. Now, only you can select the best course of action for your enterprise, and any and all sources of funding should be considered when choosing to age gracefully into obscurity. A lot of companies do shut down and start fresh with a different business widget. There's nothing wrong with that. Buy low and sell high. It's the American system. However, if you're in it for the long haul, okay, then rejuvenating your process, your people, the products, okay, before it's too late, it's really what this section is all about. Now, regardless of the path that you choose, this is the time to stand up and take a hard look, okay, at your business. Any investor would want to look at your books anyway, from angel investors to private equity to venture capitalists and growth capitalists, right? Local, regional, friends and family banks, right? Most financial officers, accountants, or CPAs can help you set up the kinds of paperwork that are necessary for raising funds in the public markets, right? But since it is a public market and an investment market like Morgan Stanley or Credit Suisse, will be required to register your IPO with the SEC in order for them and the government to have oversight over the public interest. Now these, right, are the underwriters buy your equity for a set amount and sell it. So there are necessary middlemen when dealing with the public investors. Now, in reality, going public does require a lot of expertise, a large team, money to pay the underwriting costs, especially considering that there are many other working capital options, as I mentioned before. There are inevitable problems. To whom much is given, of them much will be required, and to whom much will be trusted, even more will be asked. This is Rick Marcus from the WPLD 24 Virtual Studio.